Good morning and welcome to our latest podcast. I'm Derek Barrow from Santander Asset Management, and I'm joined this morning by our Global Head of Macro, Tactical Asset Allocation and Alpha, Hayden Davis. Good morning, Hayden.
Good morning.
Excellent. Right. So, given the recent US and UK inflation data released this week, which indicates that rising prices are heading in the right direction, albeit slowly, is there evidence for the Federal Reserve to potentially soften their stance on furthering rate rises when they meet at the end of January?
Well, I think it depends on what you mean by soften their stance. So let me qualify that. Obviously, last year we saw the Federal Reserve raise interest rates very, very sharply, the most sharply that we've seen them raise in a 12-month period since the 1990s, and similarly so with the Bank of England. So interest rates went up very sharply last year as central banks tried to catch up the fact that inflation had started rising so aggressively and moved much further than they were certainly forecasting at the start of last year. Now, it's natural that after seeing rate rises move so aggressively, that looking forward, we would expect them to start moving in smaller increments. Indeed, the Federal Reserve and the Bank of England have indicated that that's what they expect to happen at their next meeting. So the Federal Reserve has pretty much given the game away, and the markets are expecting it to raise interest rates by only 25 basis points at its next meeting. And compare that to middle of last year when the Federal Reserve was raising interest rates in 75 basis point increments. So we are getting to the end of this interest rate cycle, both in the US and UK. And of course, part of the story there is the fact that inflation does appear to be peaking. However, there are still reasons for central banks to be a little bit cautious. So whilst we are seeing central banks feeling a little bit more comfortable that they have done enough to rein in inflation, they will still be anxious not to give the markets the impression that they're going soft on inflation. So they definitely want to make sure that they get inflation under control, having let it get out of control last year. That's their mission. And whilst they're comfortable that they've probably done enough now, or within the next couple of meetings, next couple of rate rises, they will have done enough to get inflation under control. They will be very conscious that they still need to give that message. So on the one hand, it will appear that central banks are more comfortable and are prepared to soften their stance on rate rises. But in their communications, they will be saying, that they are still very much focused on bringing inflation under control. And they will be worried if markets start to get carried away or too excited. Equity markets perform very well and bond markets perform very well because that loosens financial conditions, and they need tighter financial conditions in order to bring inflation under control. So on the one hand, it will be a story of central banks coming to the end of the interest rate cycle and leaving rates unchanged, but at the same time still issuing very hawkish messages. And as far as expectations of cuts to interest rates in the UK or the US by the end of the year, that certainly looks misplaced. And every time the market starts anticipating interest rate cuts before the end of this year, certainly the Federal Reserve starts issuing communications, speeches, tries to talk the markets away from that view. And the Federal Reserve certainly thinks that it will have to leave rates unchanged throughout the course of this year. We're not going to see a sudden reversal in the interest rate cycle. So on that side of things, perhaps central banks won't be softening their stance, but certainly compared to last year, it's going to be a much softer position than we saw.
Excellent, thank you. A really comprehensive answer, Hayden. So bearing that in mind, what do we think that means for bond yields and capital value? So what does the investor journey look like in the short to medium term?
So bond yields have started to anticipate the end of this interest rate cycle, and we've seen bond yields come down from their highs back in October last year. We think that given that central banks aren't going to be in a rush to cut interest rates, there's limited downside for yields. And don't forget that when yields go down, bond prices go up. So that does cap the returns that investors can expect for the time being. But at these yield levels, we still think that maybe bonds are a reasonable investment. However, we'd be surprised if yields fell much more unless, and I'll qualify that, unless we see a marked US recession. I'll come back to that in a second. But at the moment, it would look as if 10-year yields, for example, both in the UK and the US, are probably stuck in the range of 3.5% to 4%. And at the moment, they're trading at the bottom end of that range. So we wouldn't necessarily think that yields will move much below that. But similarly, we don't think that yields are going to move sharply higher. So we're going to see a period of, we think, fairly stable yields trading in that 3.5% to 4% range. Now, the wild card here, well, maybe there are two wild cards. So the first wild card is the US economy. So if the US economy plunges into recession, and economists are sort of caught in two minds about that, I think the consensus amongst economists is that there's a 65% chance of a US recession. Economists expect a much higher probability of a UK recession. They think that the UK is already in recession. But if the US does get a move into recession, markets will start to anticipate the Federal Reserve cutting interest rates, and that will be very good news for bond markets. But for the moment, certainly the Federal Reserve is saying that even if unemployment goes up, even if there is maybe a technical recession or certainly very weak activity, markets should not anticipate falling interest rates. It's only if we see a much sharper recession or a much sharper contraction in activity than the Federal Reserve itself is expecting, that's when bonds could do very well indeed. So they would do very well in that scenario. In other scenarios, they ought to do fairly well, and certainly much better than last year when they had an absolutely abysmal year.
Excellent, thank you. So just finally then, given the conversation we've just had, how are we positioning our client portfolios as we move into quarter one?
Well, I suppose at the heart of our thinking on our positioning is the prospect for the US economy. And we're in the camp that thinks that there will be a US recession this year. There has to be a recession to bring inflation finally under control. Wage inflation is still higher than the Federal Reserve is comfortable with. For example, the housing market in the US is in a worse and worse shape, similar to housing markets elsewhere, and all because of the higher interest rates that we saw last year. So we think that there will be a noticeable downturn in activity. We've seen some advanced signs of that, but the one area we haven't really seen it yet is in the labour market. The US labour market is still very strong. Unemployment is still at multi-decade lows, just like the UK or the Eurozone. So on that note, we certainly think that the outlook for, particularly for equities, risk assets, is not very positive. If we get that recession and the markets are not priced for that, despite the fall in equity markets last year, that was all driven by higher bond yields, higher interest rates. Markets have not priced for a recession yet. And so that would come as a very unwelcome surprise to equity markets. And so we think that there is further downside, certainly in the near term for equities. As far as bond markets are concerned, well, we're a little bit more positive because inflation appears to have peaked. It is going to be falling more slowly in the UK and Eurozone than in the US. And that's mainly because of gas prices and the fact that Europe is more dependent on natural gas, whilst the US is pretty much self-sufficient as far as oil and natural gas are concerned. So it's not so much affected. So on that note, we think that bonds should perform reasonably well. But in that event that we have a recession, then bonds could do really well. So they sort of have an insurance policy in their portfolio. So we quite like them as having a part in our portfolio. But certainly our central expectation is that it wouldn't be a stellar year for bonds, but it'd just be a pretty good year for bonds this year.
Thanks, Aidan, for your detailed update. Thank you for listening to our latest podcast. The views expressed in this podcast are the views and opinions of Santander Asset Management UK and do not constitute investment or financial advice. If you want to explore more of our views and insights, please visit our website at santanderassetmanagement.co.uk. If you require advice or guidance, we would recommend you contact your professional advisor. Thank you once again for listening to our podcast, and we look forward to speaking with you again soon.